there's something really important happening in the world of banks that we need to stay on top of because it may come up slow and just kind of creep in, but we don't want another SVB. So I'm just thumbing through some charts. I'm going to land on one and do some analysis for you, but let me tell you a little story. Let me remind you of where we're at, okay? So remember Silicon Valley Bank, right? From the time of this video, that was like 7-8 months ago, that it took a massive nosedive. It just doesn't even exist anymore. And what took them down was massive investment in US government bonds, which are supposed to be like the safest investment in the world. The reason? Well, interest rates have changed dramatically over the past few years, and a lot of banks, small banks like SVB and some other ones, we're going to get to a big one shortly, they had a lot of investment in US debt, and it really tanked, right? The debt goes down, the bond prices go down when interest rates go up. So where are we now? Well, we're coming into Q4 earnings season, as the dates on some of these charts are showing you. And there is one of the banks that has more of this debt, this government bond debt, than many of the others, if not the most. So this company is reporting soon. And what I want to talk to you about is how banks are in this situation where they can take their bond debt and they can do some funny bookkeeping. Okay, it's legal, but it's kind of funky. And they can reclassify it so that they don't have to write those losses off right away. Some of them are called hold to maturity for the bonds. Some of them are called available for sale. This is getting into some nitty gritty, but what I want to keep your focus on is that if they actually wrote down their debt based off of their bond holdings and didn't use these funky classifications, some of these banks would have to write off literally like half of their capital. Now, I keep saying some, and I'm really focusing in on one. I'm just building the drama here, okay? You can see we're in the A's, and we will get to our ticker soon. So what could be on its way is something called a gray rhino event. What's a gray rhino? A gray rhino is the opposite of a black swan, okay? COVID was a black swan event, right? Nobody saw that coming. A gray rhino event is something you likely see coming, and you can be prepared for it. So the gray rhino event that we should all be ready for, starting with the next stock ticker I'm about to show you, is the impact of these massive colossal bond losses on banks, especially big banks. Because again, when it's going to hit the bigger banks, we're really going to feel it everywhere. So this gray rhino event, it might impact the banking world sooner than later. And in everything I've been studying and looking at, it starts with Bank of America. Bank of America will be sharing its Q3 earnings, as you can see here, October 17th. Okay, so that's tomorrow as of the making of this video. This says 6 a.m. Eastern. I read other places that it's 6:45, basically early tomorrow morning. And we're going to take a quick look at the chart, but I needed to tell you this context, guys, because I need you to understand that it's not necessarily like it's all going to just fall off at one time. Again, black swan was sudden and big and impactful like COVID pandemic, but a gray rhino, it can just kind of slowly sneak in and then you're like, oh crap, you're here. So let's look at this chart of Bank of America. So let's take it up to a monthly time frame, okay? And I'm going to just take off all the old annotations that are kind of cluttering it up, keep some of my past stock pick references. So you can see it ran up from the pandemic low into early 2022, like many other stocks, and has been lower since. On the monthly chart this whole time, it's been attempting to push lower beyond the bull sport power zone of my favorite momentum indicator, the RSI power zones, but not doing it. So it's attempting to stabilize at these very low prices, right? About $27. Now let's look at it in the weekly time frame. On the weekly time frame, I had put in a buy recommendation in March. I had a very close buy stop, so you wouldn't have lost much, but clearly the market did not go up from there. So I've been closely monitoring and looking at these recoveries and see they're not really having a lot of steam to them. So I think there's still a larger downtrend in play. And when you look at the weekly chart of Bank of America, you can see a red zone domination on the RSI Power Zone. So again, if you haven't dug into your RSI Power Zones education, it is the best place for you to start. with getting into my trifecta of technical analysis tools, price, time, and momentum. So check out the links near this video to dive in if you haven't already. Okay, now let's bring it to the daily time frame where we had left off, okay? Right now, just looking real simply here, we have an outside day that posted on Friday the 13th and then an inside bar after that. That kind of price action usually is the precursor to something really volatile and really big. So again, this bank is set to report earnings. Remember, I was talking before about some banks that have even more of a crappy bond holding situation than SVB did. Well, Bank of America is one of them. So just looking at some stats here, Bank of America, according to initial research I did, used to have only about 17% of its bonds in this category. Now it has 83% in that funky category where it can kind of like hide the losses. And this amount of losses from the bond holdings for Bank of America, okay, it is over $100 billion if you really dig through their accounting. So the company is worth about $200 billion, or at least has that in capital. So they'd have to write down half their capital if they actually declassified from this sort of secretive situation, all right? So I'm bringing that back because the chart of Bank of America may not look that exciting now. We may not see it this quarter in the impact on bank stocks, but I think we need to pay attention, especially to the big four, with Bank of America being the worst off at the moment. So let's do some basic technical analysis to wrap this up. Real simple, here's what I'm seeing here, okay? We have a resistance level nearby at $27.99 per share. And that's an important resistance level that's also near some old bottoms. So if Bank of America is able to recover above there, or maybe on the earning news it'll gap higher, it likely has legs to get to like $29.50, all right? But if this area holds, if it's not able to clear $27.99, then it's in a position to resume lower. How far lower? Well, let me do a quick forecast. Again, it's not confirmed yet because we haven't had a break below Friday's low, but if it does unfold, here's what we could see. All right, so here it is. If Bank of America stock's not able to climb above $27.99, that's step one. And if it then posts a daily closing break below $26.52, again, with earnings coming out, who knows, this could be some dramatic activity. That would expose a low here at $25.47, and the downside target per a forecast, the meeting of time and price, would be for shares to trade to $23.75 by November 6th. So here we are on Monday, October 16th. So that's a couple weeks out, but you get the idea here, guys. All right. So again, this is just one important bank that is caught up in the situation. There are many others. So if you are trading S&P 500 stocks in the XLF sector, if you're trading any other bank stocks, be careful out there right now because earnings season will tell us, especially when we look at how they are now recognizing that bond activity on the books. All right. So hopefully, if there's going to be a gray rhino, I can help you see it coming. And again, I have many tools and education to empower you to find those setups as well. So if you haven't already, and if you found value in this video, please punch that like button and hit subscribe so you can follow me for more, and I'll catch you next time.